There is a number, and most Australians have no idea it exists. And if you have more money than that number sitting in a single bank account right now, you could be about to make one of the most expensive mistakes of your financial life. But the number itself is only half the story, because even if you stay well under it, you could still be silently losing thousands of dollars every single year without a single transaction leaving your account. Today, we are going to break down exactly how much you should keep in your Australian bank account, why that number matters, and what you should actually be doing with everything above it, because the difference between understanding this and ignoring it is the difference between money that works for you and money that slowly disappears. Let's start with the number that most Australians either don't know or don't think applies to them. $250,000. That is the maximum amount the Australian government will protect if your bank collapses. And it is the single most important number when it comes to how much cash you should ever have sitting inside one institution. And here is where it gets really important, because this isn't some theoretical financial concept. This is a real legally backed government guarantee, administered by APRA, the Australian Prudential Regulation Authority, under a scheme called the Financial Claims Scheme, or FCS. And what it says is this: if your bank building society or credit union is authorised by APRA and it fails, the government will step in and guarantee your deposits up to $250,000 per account holder per institution. They aim to return that money to you within 7 calendar days. But here is the part that catches people out. That $250,000 limit applies to the total of all your accounts combined at that one institution, not per account. So, if you have a transaction account, a savings account and a term deposit all at the same bank, all under your name, and the combined balance is $300,000. You are only protected for $250,000 of it. That extra $50,000 is completely unprotected, and if that bank were to fail, it could be gone. Now, before anyone stops watching and says that will never happen, here is the reality. Bank failures are rare in Australia, but they are not impossible. We have seen financial institutions go under in this country before and around the world. Major banks that everyone assumed were untouchable have collapsed. The reason most Australians don't think about this is because our banking system is strong and APRA does excellent work regulating it, but strength is not the same as invincibility, and the peace of mind that comes from knowing your money is protected costs you absolutely nothing. It is a free government guarantee that millions of Australians are accidentally leaving on the table simply because they don't know the rules. So the first rule is simple. Never keep more than $250,000 in deposits with any single banking institution. If you have more than that, spread it across multiple APRA-authorised banks. And here is the part the people miss if you are in a joint account. Each account holder gets their own $250,000 protection, so a couple with a joint account can have up to $500,000 covered at the same institution, but that only applies to the joint account itself. Your individual accounts at the same bank still count toward your personal $250,000 limit. So the structure matters as much as the numbers, but here is where the conversation gets more interesting and more relevant for the vast majority of Australians who are nowhere near $250,000 in a single bank account. Because even if you have $20,000, $50,000 or $100,000 sitting in a standard bank account, you are probably still making a mistake. And that mistake is not about the government guarantee at all. It is about the silent tax that nobody warns you about, and it is called inflation. The Australian Bureau of Statistics released the CPI data for March 2026, and headline inflation is running at 4.6% annually, housing is up 6.5%, transport is up 8.9%, food and non-alcoholic beverages are up 3.1%. The trimmed mean, which strips out the most volatile categories, is sitting at 3.3%. That is the number the RBA pays closest attention to and what all of this means. For the money sitting in your bank account is brutal. If you are earning nothing on that money or close to nothing, it is losing purchasing power at a rate of 3 to 5% every single year. A $20,000 emergency fund, sitting in a standard Big Four bank transaction account, earning 0.01%, is effectively shrinking by $600 to $1,000 every year in real terms, and you will never see that loss on your statement because the number doesn't go down, the world around it just gets more expensive. This is the invisible cost that most Australians never calculate, and it compounds just like interest does, except in reverse. If you leave $50,000 in a no-interest transaction account for 10 years and inflation averages 3.5% over that period, the real purchasing power of that $50,000 drops to about $35,000. In today's money, you haven't lost a cent on paper, but you have lost $15,000 of buying power in reality, and the bank says nothing because from their perspective everything is fine. So now we have two separate problems. You need to make sure your money is protected by the APRA government guarantee, and you need to make sure your money is not silently losing value to inflation. And the solution to both of these problems is the same thing. You need a strategy for how you structure your cash and what you do with everything above your cash needs. Let's build that strategy right now, starting with the most important category, your emergency fund. Every Australian needs a cash emergency fund. This is non-negotiable. It is the financial buffer that stops you from going into debt. The moment life sends an unexpected bill, and life always sends unexpected bills, the question is, how big does it need to be? The Money Smart website from ASIC recommends 3 months of essential expenses as a minimum, but given the current cost of living environment and the fact that the RBA cash rate is at 4.1%, meaning a potential job loss in a tightening economy could take longer to recover from than in previous cycles, 6 months of essential expenses is the smarter target for most Australians. What does that actually look like in dollar terms? For someone spending $3,000 a month on essential living costs, rent or mortgage, groceries, utilities, transport and insurance, a 6-month buffer is $18,000 for someone spending $4,000 a month. It is $24,000 for a couple spending $6,000 a month combined. It is $36,000. This emergency fund should live in a high-interest savings account, not your transaction account, not a term deposit, and definitely not under the mattress. Right now in Australia, you can get ongoing rates of between 5 and 5.5% from providers like ING Savings Maximiser and UBank Save, with Macquarie sitting just under that at around 4.75 to 5%, with no conditions, which makes it the easiest option for people who don't want to jump through hoops. The difference between parking your emergency fund at 0.01% in a Big Four transaction account versus 5% in a high-interest savings account on an $18,000 emergency fund is $900 a year. That's free money for doing nothing except opening the right account, and it takes about 10 minutes. Now, let's talk about what sits above your emergency fund, because this is where most Australians are losing the most money. Not in hundreds, but in thousands every single year. And it comes down to one fundamental mistake. They keep money in the bank that should be invested. If you have savings above your emergency fund that you won't need for at least 3 to 5 years, that money should not be sitting in a bank account earning 5% while inflation runs at 4.6%, because your real return after inflation on a 5% savings account is less than 0.5%. And once you factor in that savings account interest is taxed at your marginal rate, it could actually be negative in real terms for anyone in the 30 or 37% tax bracket. Let's run the actual numbers on this. A savings account earning 5% for someone on a taxable income of $100,000 means their marginal tax rate is 30%. So after tax, the real yield on that savings account drops to 3.5%, and with CPI at 4.6%, the real after-tax return is negative 1.1% per year. You are going backwards while feeling like you are doing the right thing. Contrast that With $100 invested in a diversified ASX ETF like VAS, which tracks the ASX 300, historically returning around 10% per year, including dividends and franking credits, and you start to see why keeping too much money in the bank is genuinely one of the most expensive financial habits in Australia. The point isn't that bank accounts are bad. They are essential for the right amount of money, for the right purpose. The point is that every dollar sitting in a bank account above what you actually need for short-term goals and emergencies is a dollar that is not working as hard as it could. So, here is the framework for how much to keep in your Australian bank account and what to do with everything else. First, keep $0 in a no-interest transaction account beyond what you need for your next 2 weeks of bills. Everything else should be earning interest. Second, keep 3 to 6 months of essential expenses in a high-interest savings account at 5% or more with a fully APRA-guaranteed institution. Third, if you are saving for a specific goal within 1 to 3 years, like a house deposit or a car, that money can sit in a high-interest savings account or a term deposit where you can currently lock in rates of between 4.5 and 5.5% for terms of 3, 6, or 12 months depending on what the banks are offering. And fourth, anything above these buckets that you won't need for at least 3 to 5 years should be going into investments. And for most Australians, that means a diversified ETF portfolio in your own name inside super through salary sacrifice or ideally both. Now, let's address the specific situation of people who are approaching or above that $250,000 government guarantee threshold, because this is more relevant than most people think, especially for anyone who has sold a property, received an inheritance, is sitting on a large redundancy payment, or has simply been saving diligently for many years. If you have more than $250,000 in cash that needs to stay as cash, not because it should be invested, but because you are saving for something specific in the near future, the solution is straightforward. Spread it across multiple APRA-authorized institutions, making sure your total balance at any single scare institution never exceeds $250,000 for individual accounts or $500,000 for joint accounts. Remember that CBA and Bankwest operate under the same banking license, so deposits across both count as one institution towards your limit. The same applies to NAB and UBank and any other parent bank that operates multiple brands under a single APRA license. Always check the APRA website directly to confirm which brands are covered under the same license before assuming your deposits are separately guaranteed. And there is one more thing that most people never think about when they are sitting on a large amount of cash waiting to deploy it, and that is the tax on the interest your savings account earns. Every dollar of interest you earn from a savings account or term deposit is added to your taxable income for the year and taxed at your marginal rate. So, if you are in the top bracket and you have $500,000 sitting in a savings account earning 5%, there is $25,000 of interest income being taxed at 47 cents in the dollar, meaning the government is taking $11,750 of your interest before it even hits your hand. Your actual after-tax return is barely $13,000 on $500,000 of cash. This is one of the reasons smart Australians with significant capital work with financial advisors and accountants to structure where and how their cash is held before parking large sums in simple savings accounts. So, let's bring this all together, because the answer to how much you should keep in your Australian bank account is not a single number. It is a structure. The right amount in a transaction account, just enough for your bills, the right amount in a high-interest savings account, your emergency fund, plus any short-term savings goals, and the right amount in investments, everything above your emergency fund that has a time horizon of 3 years or more, and critically never more than $250,000 per person per institution, no matter what. Because beyond that, you are taking on risk that the government has already built you a free way to avoid. The Australians who build real wealth over time are not necessarily the ones who earn the most. They are the ones who understand that every dollar has a job, and the job of your bank account is safety and liquidity for your short-term needs, not long-term wealth building. Every dollar you keep in a bank account above what you genuinely need is a dollar that should be out in the world growing, and the longer you leave it sitting idle, the more of your financial future you are quietly handing away to inflation 1 invisible percent at a time. And before we finish, there is one more trap that catches thousands of Australians every single year, and it sits right at the intersection of trying to do the right thing and not reading the fine print closely enough. And it is called the introductory rate honeymoon. And here is how it works. You see a savings account advertised at 5.9% per annum. You think, that is incredible. You open the account, you move your money over, and for the first 4 months you earn that headline rate and you feel like a financial genius. Then month 5 arrives, and the rate quietly drops to 2.5%, or sometimes even lower because the promotional period has ended, and unless you are watching your account closely, you might not even notice for weeks or months, while your money silently earns a fraction of what you thought it was earning. Almost every high-rate savings account in Australia right now uses this honeymoon structure. UBank offers 5.85% for the first 4 months. ING Savings Accelerator offers 5.85% for the first 4 months on balances between $150,000 and $500,000. Bankwest Easy Saver offers 5.75% for the first 4 months. These are all genuinely competitive products when you are inside to the promotional window. But the moment that window closes, you need to either move your money to a new account with a fresh promotional rate or accept a much lower ongoing rate, and the banks are absolutely counting on you forgetting to do this because your financial inertia is literally their profit margin. The smarter approach if you want to play the honeymoon rate game is to set a calendar reminder for the exact day your introductory period ends and be ready to move your funds to the next best offer on the market. At that point, this is called rate chasing. And while it sounds more complicated than it is worth, on an $18,000 emergency fund, earning an extra 2% means an extra $360 a year before tax. That is worth one calendar reminder every 4 months for most people. Alternatively, if you would rather not think about it at all, Macquarie Bank has consistently been one of the strongest no-conditions ongoing options in Australia, sitting around 4.75 to 5% with no monthly hoops to jump through, no minimum deposit requirements and no required card transactions. You just open the account and earn the rate that simplicity has real value, because the best savings account is always the one you will actually use consistently, rather than the one with the highest theoretical rate that you forget to manage. And then there is the question of term deposits, which work differently to savings accounts, and deserve a mention because for the right kind of money they make a lot of sense. With a term deposit you lock your money away for a fixed period, typically 3 months, 6 months or 12 months, and you receive a guaranteed fixed interest rate for that entire period. Right now in Australia, term deposit rates are sitting between 4.5 and 5.5% depending on the institution, and the term. The key advantage is certainty. You know exactly what you will earn for the full period, regardless of what the RBA does with the cash rate, and in an environment where rates could move in either direction, that certainty has genuine financial value. The key disadvantage is that your money is locked up, and if you need access before the term ends, you will almost certainly pay a penalty in the form of a reduced interest rate, so term deposits make the most sense for money you are certain you will not need for the full duration. Things like savings earmarked for a property purchase that is 12 months away, or a portion of your cash above your emergency fund that you want to ring-fence at a fixed rate while you decide where to invest it longer term. The overall picture when it comes to cash in Australia in 2026 is more nuanced than most people realise. You have a government guarantee that protects you up to $250,000 per institution, but that only matters if you have that much cash, and most Australians don't. You have inflation running at 4.6%, headline according to the ABS, which quietly erodes the purchasing power of every dollar sitting idle. You have savings accounts offering between 4.75 and 5.9%, which in the current environment barely keeps pace with inflation before tax, let alone after it, and you have a genuine long-term opportunity cost represented by a diversified ASX ETF portfolio that has historically delivered around 10% per year, including dividends and franking credits, versus the real return of close to 0% you might scrape from a savings account after tax and inflation. None of this means your savings account is the enemy. It means your savings account has a specific job to do, and that job is to hold the exact amount of cash you need for safety and short-term purposes. Nothing more and nothing less. Every dollar above that purpose has somewhere better to be. And the sooner you understand that, the sooner your money starts doing the one thing that actually builds long-term wealth in this country: compounding. If this changed the way you think about your cash, hit the like button and subscribe to the channel for more straight-talking Aussie finance content. Thanks for watching, and I'll see you in the next one.